Finance currency here. What you're about to hear isn't comfortable. It's not designed to make you feel good. It's designed to make you think. 7 trading days, that's all it took. Silver collapsed 47% from $120 to $65, the fastest precious metals crash since the Hunt brothers squeeze unwound in 1980. 7 days, nearly half the price gone. Billions wiped from portfolios, panic selling at levels that broke exchanges. Margin calls cascading like dominoes. Social media screaming silver is dead. Mainstream media running obituaries for the precious metals bull market. Then something happened that nobody in those headlines mentioned. 24 hours later, silver rockets 22% from $65 to $78. Bitcoin pumps $11,000 in a single session. $340 billion floods back into crypto markets. Over $1 trillion returns to U.S. equities in just 2 hours. Dow Jones hits a new all-time high. Russell 2000 recovers 100% of yesterday's losses. The same assets that crashed violently recovered violently. The same markets that bled panic suddenly pumped euphoria. Still think this is normal? Let me be crystal clear before we go further. This channel has never asked for money. Not donations, not subscriptions, not premium groups, not trading signals. Anyone using the finance currency name to request money is a scam. Report them. Block them. This channel exists for one purpose only: education through analysis. Not hype, not hopium, not doom. Analysis. If you want someone to tell you silver is going to moon every day regardless of what the charts say, there are plenty of channels for that. If you want someone to tell you silver is dead every time there's a red candle, there are channels for that too. They'll tell you what you want to hear. They'll sell you certainty in a market that has none. They'll repackage what I say and spin it into whatever narrative keeps you clicking their videos. That's not what we do here. Finance currency was built on a simple principle. Markets are complex. Analysis should be honest. And you, the viewer, deserve to understand what's actually happening rather than what someone wants you to believe is happening. That means covering bullish factors and bearish factors. That means acknowledging when we don't know. That means giving you data and letting you decide. So let's get into what actually happened over the last 7 days. Because if you only followed mainstream headlines, you saw a crash. If you only followed social media, you saw panic. But if you followed the data, you saw something entirely different. You saw a pattern that's been repeating all of 2026, a pattern that makes no sense if markets are free, a pattern that makes perfect sense if markets are something else entirely. Here are the numbers. Silver opened the week at $120.40. By Thursday's low, it touched $64.80. That's a 46.17% decline in precisely 7 trading sessions. For context, silver's average weekly volatility over the past decade is approximately 3.2%. This move was 14 times normal volatility. 14 times. In a market that's supposed to be regulated, in a market with circuit breakers, in a market that claims to have oversight. During those 7 sessions, here's what else happened. COMEX silver open interest collapsed from 189,000 contracts to 142,000 contracts. That's 47,000 contracts liquidated. Each contract represents 5,000 ounces. That's 235 million ounces of paper silver that simply vanished from the market. Where did it go? Who was forced to sell? Why did this happen so fast? The relative strength index on silver went from 78 in mid-December to 26 at Thursday's low. For those unfamiliar, RSI measures momentum. Above 70 is overbought, below 30 is oversold. Silver went from extremely overbought to extremely oversold in a single week. The kind of RSI compression that normally takes months happened in days. Meanwhile, on Thursday night, something shifted. Silver began recovering. By Friday morning, it had reclaimed $72. By Friday close, $76. By Saturday's Asian session open, $78. 22% off the lows. In 24 hours. Same speed down, same speed up, almost like someone flipped a switch. At the exact same time, Bitcoin recovered from $59,000 to $70,000. Ethereum recovered from $1,750 to $2,050. Total crypto market cap added $340 billion. U.S. stocks added over $1 trillion in market value in 2 hours. The Dow closed at a new all-time high. The Russell 2000 added $100 billion in market cap. Risk assets across every category crashed together and recovered together. This is the part where I ask you to stop and think. If these were separate markets driven by separate fundamentals, why did they crash at the same time? Why did they recover at the same time? Why was the magnitude so similar? Why was the timing so precise? The official explanation is volatility. The official explanation is tariff concerns. The official explanation is risk-off sentiment. But volatility doesn't explain perfectly synchronized moves across uncorrelated asset classes. Tariff concerns don't explain why Bitcoin and silver move in lockstep. Risk-off sentiment doesn't explain a 22% recovery in 24 hours. Something else is happening here. And if you're watching this channel, you probably already sense that. The question isn't whether markets are manipulated. At this point, asking that question is almost naive. The question is how they're manipulated, who benefits, and what that means for your positioning. Over the next sections of this analysis, we're going to break down exactly what happened during this crash, exactly what happened during this recovery, what the COMEX data tells us, what the lease rate data tells us, what the Chinese vault data tells us, and most importantly, what comes next. Because here's the thing about manipulation. It works until it doesn't. Paper games function until physical reality overwhelms them. And right now, the data suggests we're approaching that threshold faster than most people realize. This is finance currency. Let's get into the analysis. Let's break down exactly how silver lost 47% in 7 trading sessions. Because when you understand the mechanics of the crash, the manipulation becomes obvious. Day 1. Silver opens at $140. Within the first hour of trading, a wave of selling hits COMEX. Not small orders, not retail selling. We're talking concentrated selling pressure in the first 30 minutes of the session when liquidity is thinnest. Classic playbook. Hit the market hard when there's no one to absorb the blow. Silver drops to $114 by lunch, closes the day at $112, down 7% on no news, no fundamental catalyst, just selling. Day 2, silver opens weak at $110. The European session sells into the Asian bid. London fixes silver lower, more concentrated selling at the COMEX open. Silver drops to $104 by mid-session, bounces slightly, closes at $106, now down 12% in 2 days. Social media starts panicking. What's happening to silver? Mainstream media silent. No headlines, no explanation, just red candles. Day 3, margin calls begin. When you trade futures on leverage, there's a maintenance margin requirement. When price moves against you past a certain threshold, your broker forces liquidation. It's not optional, it's automatic. Day 3 is when the cascading begins. Leverage longs who bought at $110, $115, $120 start getting liquidated. Each liquidation adds selling pressure. Each liquidation triggers more liquidations. Silver drops from 106 to 94, down 22% in 3 days. The speed is violent. Day 4. Panic sets in. Retail traders who bought physical silver see their paper portfolio values collapsing. Mining stocks crater. SIL ETF drops 18% in a single session. CLJ drops 24%. The silver mining sector loses $15 billion in market cap in 1 day. Social media goes from concern to fear. Is the bull market over? Did I buy the top? Silver is dead. Comment sections flood with capitulation. This is exactly what the selling pressure was designed to create. Emotional response, panic selling, weak hands giving up. Day 5, silver breaks below $85. This is the level that held during the February pullback, the level that held during the January correction. Technical support shatters. When key levels break, algorithmic traders flip short. When algos flip short, selling accelerates. Silver doesn't just drift lower, it plummets. From $85 to $76 in a single session, down 37% from the high. Volume spikes to 2.3 times normal. But here's the detail nobody mentions. The volume spike isn't buying, it's liquidation, forced selling, margin calls executing, stop losses triggering, leverage positions unwinding. Day 6. Silver opens at $74. For a moment, it looks like stabilization. Then the European session hits. Another wave of concentrated selling. Silver breaks $70. The psychological level that everyone said would hold forever. It doesn't hold. Silver touches $68 intraday, bounces to close at $71, down 41% from the high. RSI hits 29, 1 point above the most oversold reading possible before technical analysts start screaming, buy. But who's going to buy? Everyone is scared. Everyone is bleeding. Everyone is watching their portfolio in ruins. Day 7. The kill shot, silver opens at $71. Within 45 minutes, it breaks 65. The speed is almost comical, $6 in 45 minutes, 8.5% in less than an hour. This is where the final margin calls execute. This is where the last leveraged longs get liquidated. This is where the capitulation becomes complete. Silver touches $64.80, down 46.17% from $120.40 in exactly 7 trading sessions. Now let's look at who was selling. COMEX data shows commercial traders, primarily banks and large institutions, added 34,000 new short contracts during this 7-day period. That's 170 million ounces of paper silver sold short into a declining market. They weren't selling to take profit. They were selling to push price lower. They added shorts at $110. They added shorts at $100. They added shorts at $85. They added shorts at $70. Concentrated, coordinated selling designed to break the market structure. Meanwhile, managed money, which includes hedge funds and CTAs, liquidated 52,000 long contracts. They didn't sell because they wanted to. They sold because they were forced to. Margin calls, stop losses, systematic deleveraging. The open interest data tells the whole story. Open interest collapsed from 189,000 contracts to 142,000 contracts. That's a 25% reduction in total market positioning. In 1 week, the specs got completely flushed. The leveraged longs got completely liquidated. The paper market underwent a full reset. And here's the detail that matters most. While paper markets were collapsing, physical markets were tightening. The silver lease rate in London jumped from 2.3% to 6.1% during this exact week. Lease rate represents the cost of borrowing physical silver. When lease rates spike, it means physical silver is scarce. It means someone is paying a premium to get their hands on real metal. If silver was truly in oversupply, if demand was truly collapsing, if the bull market was truly over, lease rates would be dropping, not spiking. You can manipulate price. You can print paper contracts. You can crash markets with concentrated selling. But you can't fake the lease rate. You can't create physical silver that doesn't exist. The crash was manufactured. The crash was designed. The crash served a purpose. And that purpose was to shake out every weak hand, liquidate every leverage position, and reset the market for what comes next. What comes next? A 22% recovery in 24 hours. Almost like someone knew the selling was finished. Let's examine the recovery with the same precision we used for the crash, because the recovery tells us just as much about market structure as the collapse did. Thursday, 8:47 p.m. Eastern Time. Silver is sitting at $64.80, the lowest price since April 2025. Social media is declaring the bull market dead. YouTube channels that were screaming silver to 200 2 weeks ago are now running videos titled Why I Sold All My Silver. The sentiment has completely flipped. Fear is maximum. Capitulation is complete. Then the buying begins. The first hour sees $240 added to the price, from $64.80 to $67.20. This isn't retail buying. Retail is scared. Retail is paralyzed. This is institutional accumulation, large blocks, concentrated buying. The same entities that crashed the market are now accumulating at the lows they created. The Shanghai market opens. Chinese buyers, who have been systematically draining Western vaults for years, see $65 silver and begin aggressive accumulation. SGE premium over London spot jumps to $4.20 per ounce. Chinese buyers are paying $69 for silver that the Western paper market says is worth $65. Why would they pay a premium if silver was truly oversupplied? Why would they pay extra if demand was collapsing? By midnight Eastern, silver has reclaimed $70. The psychological level that broke on the way down is recaptured in 3 hours on the way up. Volume is heavy. Buyer aggression is obvious. The same speed that characterized the crash now characterizes the recovery. Friday morning, European session. Silver gaps higher at open. London fix is at 73.20. The fix, which was used to suppress price on the way down, is now confirming higher prices on the way up. COMEX opens at 8:25 a.m. Eastern. Silver immediately pushes to $75. No resistance, no selling pressure, just buying. By Friday close, silver is at $76.40. Saturday's Asian session adds another $160. By the time most Western traders check prices on Saturday morning, silver is at 78 ounce, 22% off the Thursday low in approximately 24 hours of trading. Let's compare the mechanics. The crash. Concentrated selling, thin liquidity targeting, margin call cascades, leveraged position liquidation, fear generation, capitulation creation. 7 days. 47% lower. The recovery, concentrated buying, strong accumulation, short squeeze pressure, sentiment reversal, momentum algorithms flipping long, 24 hours, 22% higher. The speed is identical. The mechanics are identical. Only the direction changed. Here's what the COMEX data shows. During Friday's session alone, commercial traders covered 18,000 short contracts. That's 90 million ounces of paper shorts closed in a single day. They shorted into the crash, they covered at the low, the same pattern, every single time. Short interest data shows $550 million in crypto shorts liquidated on Friday. That's leveraged bears getting squeezed as Bitcoin reclaimed $70,000. The same dynamic playing out across every risk asset simultaneously. Let me show you something that should make the pattern crystal clear. Mid-December, silver at 65, RSI at 78. Sentiment bullish, everyone buying, Thursday low, silver at 65, RSI at 26. Sentiment bearish, everyone selling. Identical price level, completely inverted positioning. In December, $65 was a buying opportunity everyone was excited about. In January, $65 was a capitulation low everyone was terrified of. Same price, different psychology. The manipulation isn't just about moving price, it's about moving sentiment. It's about shaking out weak hands at the bottom and letting strong hands accumulate. Now let's look at what recovered alongside silver. Bitcoin, $59,000 to $70,000. 18.6% gain, $11,000 added in 24 hours. Ethereum, $1,050 to $2,050. 17.1% gain, $300 added per token. Total crypto market cap, $340 billion added in 20 hours. Dow Jones, up 950 points, new all-time high. S&P 500, fully recovered from Thursday's crash. NASDAQ, 100% reversal of Thursday losses. Russell 2000, up 3.1%. $100 billion in market cap added. Every single risk asset, every single category, crashed together, recovered together. The official explanation is markets stabilized on trade optimism. Really? Trade optimism appeared at exactly 8:47 p.m. Eastern Time. Trade optimism hit every asset class in the same hour. Trade optimism created identical recovery patterns across stocks, crypto, and metals. The alternative explanation is simpler. The same entities control all these markets. The same algorithms trade all these assets. The same manipulation playbook applies across categories. When they decide to crash markets, everything crashes. When they decide to pump markets, everything pumps. Here's the data point that confirms this. The correlation between Bitcoin and silver has reached 0.87 over the past 30 days. That's nearly perfect correlation. Bitcoin and silver have zero fundamental connection. One is a digital asset, one is a physical metal. They serve different purposes, they have different supply dynamics, they have different demand drivers, yet they move together with 87% correlation. That correlation isn't natural, that correlation is manufactured. That correlation exists because the same trading algorithms, controlled by the same institutions, execute the same strategies across both markets simultaneously. The recovery wasn't organic, the recovery was engineered, just like the crash was engineered. The market makers who pushed silver to $65 are the same market makers who pushed it to $78. They make money in both directions, they control both directions, and until physical demand overwhelms their paper games, they'll continue controlling both directions. But here's where it gets interesting. The physical market is tightening, the paper market just got flushed, and March delivery is 21 days away. Let's stop dancing around the topic and address it directly. What you witnessed over the past 7 days wasn't a market correction, it wasn't profit-taking, it wasn't a healthy pullback. It was manufactured, designed, executed with precision. Markets are manipulated, news is manipulated, history is manipulated. But you can't hide truth forever. Here's how the manipulation works in silver markets. The COMEX is a paper exchange, futures contracts representing silver that may or may not exist. For every ounce of registered silver in COMEX vaults, there are approximately 4.1 ounces of paper claims against it. This is called fractional reserve trading. It works as long as everyone agrees to settle in cash rather than demanding physical delivery. When banks want to suppress silver price, they sell paper contracts, not physical silver, paper claims. They can sell unlimited quantities because they're not actually selling metal, they're selling promises. They concentrate this selling during thin liquidity periods. Early morning, late evening, holiday periods. When there's no natural buying to absorb the selling, price moves farther with less effort. During last week's crash, commercial traders added 34,000 new short positions. That's 170 million ounces of paper silver created from thin air and sold into the market. The registered silver inventory at COMEX is 103 million ounces. They sold more paper silver in 1 week than physically exists in their vaults. This is legal, this is normal, this is how the system works. But here's the constraint they can't escape: physical delivery. When a futures contract approaches expiration, holders can demand delivery. They can say, I don't want cash settlement, I want my silver. And the exchange has to provide it. If they can't, it's called a default. And defaults break confidence. Defaults break the system. Let me show you the current COMEX math. March 2026 open interest, 85 out of 800 contracts. Each contract represents 5,000 ounces. Total exposure, 429 million ounces. COMEX registered silver inventory, 103.5 million ounces and falling. Available supply, 103 million. Paper claims, 429 million. The ratio is 4.14 to 1. First notice day for March delivery, February 27th, 2026. That's 21 days away. Now let's look at recent delivery patterns. January 2026 deliveries, 49.4 million ounces. This was 7.27 times the January 2024 delivery level. 7 times. In 1 year, February 2026 delivery rate, 98%. Almost everyone who held contracts into delivery month demanded physical metal. Inventory drainage rate, 785,000 ounces per day, leaving registered vaults. At current drainage rates, COMEX will have approximately 85 million ounces registered by March 1st. Here's the crisis math. If March sees a 25% delivery rate, which is low by recent standards, that's 107 million ounces demanded against 85 million available. If March sees a 50% delivery rate, which matches January's intensity, that's 214 million ounces demanded against 85 million available. If March sees a 70% delivery rate, which matches February's intensity, that's 300 million ounces demanded against 85 million available. There is no scenario where the math works. Either delivery rates collapse back to pre-2025 levels, or COMEX faces a structural crisis in 21 days. The banks know this. Why do you think they crashed silver 47% last week? To shake out as many longs as possible before March. To liquidate leveraged positions, to reduce open interest, to make the delivery math more manageable. It worked partially. Open interest fell from 189,000 contracts to 142,000 contracts, but 85,800 contracts still remained for March. That's still 429 million ounces of potential demand. Now let's look at what's happening in China. Shanghai Futures Exchange plus Shanghai Gold Exchange combined silver inventory, approximately 850 tons. That's down from over 7,400 tons in 2020. They've drained 6,600 tons in 6 years. That's 90% of their inventory gone. Current drainage rate, 73 tons per day. At this rate, Chinese vaults empty in 11 days. Chinese buyers aren't panicking during the price crash. They're accumulating. SGE premiums remain elevated. Physical demand remains strong. They're using low paper prices to acquire physical metal at a discount. Meanwhile, the silver lease rate in London jumped to 6.1% for 1-month contracts. For context, the average lease rate over the past decade is approximately 0.5%. We're at 12 times normal. Lease rates spike when physical silver is scarce, when holders don't want to lend, when borrowers are desperate. Silver also remains in backwardation. This means spot prices exceed futures prices. In a normal market, futures trade at a premium because of carrying costs. Backwardation means the market is paying more for silver now than silver later. That only happens when immediate physical supply is constrained. The Seville index, which measures silver market tightness, has reached 106.35. Any reading above 100 indicates supply stress. We're in stress territory and climbing. Here's what Bloomberg reported last month, and I quote, "Banks don't have infinite balance sheets to trade precious metals. That's the structural constraint nobody talks about. They can suppress price with paper, but paper requires balance sheet capacity. It requires margin. It requires capital. When physical demand exceeds their ability to supply, when delivery obligations exceed inventory, the paper game ends. That's what March represents. A test of the system. A delivery month where the math doesn't work. A moment where physical reality confronts paper fiction. Did the banks crash silver 47% to prepare for this? Did they liquidate leveraged longs to reduce March exposure? Did they engineer the entire 7-day collapse as a pre-positioning move for what's coming? The data says yes, the pattern says yes, the timing says yes, 21 days, the countdown has begun. Now comes the part most channels skip, the honest risk assessment. Because analysis isn't about telling you what you want to hear. It's about preparing you for what might actually happen. Silver bounced 22% from $65 to $78. The data suggests physical tightness. The COMEX math suggests crisis. The lease rate suggests scarcity. But does this guarantee the bottom is in? No, it doesn't. Let me show you why we need to remain cautious. Bitcoin's historical drawdown patterns. Every major Bitcoin bear market over the last 14 years has seen drawdowns of at least 75% from all-time highs. 2011, 93% drawdown. 2015, 84% drawdown. 2018, 83% drawdown. 2022, 76% drawdown. Each successive bear market bottom gets shallower. The polynomial trend suggests the next projected trough around 70% drawdown. From Bitcoin's high near $110,000, a 70% drawdown implies approximately $33,000 to $38,000. Why does this matter for silver? Because the correlation between Bitcoin and silver has reached 0.87. They're moving together with near-perfect synchronization. If Bitcoin hasn't completed its correction, silver probably hasn't either. Bitcoin reclaimed $70,000 on Friday. But technical structure suggests this may be a relief rally within a larger correction rather than the definitive bottom. If Bitcoin drops to the historical 70% drawdown level, silver likely follows. Here's the honest framing. Did we just see the low at 65? Possibly. The 22% bounce is significant. The structural indicators suggest capitulation. But is it confirmed? No, not yet. Confirmation requires price building a base. Confirmation requires higher lows. Confirmation requires sustained recovery rather than just a violent bounce. Violent moves down often lead to violent moves up, but violent bounces sometimes lead to lower lows. That's the nature of volatility. That's the reality of leveraged markets. Anyone who tells you they know for certain which scenario plays out is either lying or delusional. What do I think? I think the structural tightness is real. Lease rates at 6.1% are not normal. Backwardation is not normal. Chinese vault drainage of 73 tons per day is not normal. COMEX open interest collapse to 2018 levels means specs are washed out. These are exhaustion signals. These suggest selling pressure is spent. But I also think Bitcoin's technical structure matters. I think correlation to crypto creates vulnerability. I think 21 days is a long time for more volatility to unfold. The balanced view, lows are likely in, but not definitively confirmed. Prices will generally trend higher in weeks ahead, but more volatility is possible. The bull market isn't broken, but the correction might not be complete. Let me give you 3 takeaways from everything we've covered. Takeaway 1. The crash was manufactured, but the recovery was real. Silver didn't drop 47% because fundamentals deteriorated. Silver dropped 47% because commercials added 170 million ounces of paper shorts, triggered margin call cascades, and flushed leveraged longs. The recovery happened because physical buyers stepped in at $65, shorts covered at the lows, and the selling pressure exhausted itself. The manipulation works until physical overwhelms paper. At 6.1% lease rates, with Chinese vaults draining 73 tons daily, with COMEX registered inventory at 103 million against 429 million exposure, we're approaching that threshold. March delivery, 21 days away, will test whether the paper market can survive another stress event. Takeaway 2. Perspective matters more than price. Silver at $65 with RSI at 80 in December was a very different setup than silver at 65s with RSI at 26 today. Same price, completely different context. In December, everyone was bullish. Leverage was maximum. Correction was coming. In January, everyone is bearish. Leverage is flushed. Recovery is possible. Long-term charts show this pullback as a retest of the breakout level, not a reversal of the bull trend. Silver adjusted for M2 money supply hasn't even reached the 2011 extreme. There's significant room to run if the fundamentals remain intact. And the fundamentals remain intact. Global silver supply is constrained. Industrial demand is growing. Investment demand is strong. Nothing about the long-term thesis has changed. Takeaway 3. Know your time frame and manage your risk. If you're a trader, this volatility is opportunity. Buy fear, sell greed, rinse and repeat. The 47% crash and 22% recovery created massive profit potential for those positioned correctly. If you're an investor, this volatility is noise. Focus on accumulation during weakness. Focus on fundamentals over price action. The miners are about to report earnings showing 1,200% profit increases. Analysts will be forced to upgrade valuations. The disconnect between silver price and miner valuations will close. If you're leveraged, this volatility is dangerous. The 47% crash liquidated everyone with more than 2x leverage. Leverage amplifies gains, but it also amplifies losses. In a manipulated market where 47% crashes happen in 7 days, leverage can destroy you. Final summary. Silver crashed 47% in 7 trading days, the fastest precious metals collapse since 1980. The crash was manufactured through concentrated paper selling, margin call cascades, and leveraged position liquidation. It served one purpose, to shake weak hands and reset positioning before March delivery. Silver recovered 22% in 24 hours. The recovery was driven by physical accumulation, short covering, and exhaustion of selling pressure. Structural indicators confirm tightness. Lease rates at 6.1%, backwardation continuing. Chinese vaults draining, COMEX inventory inadequate. The question isn't whether silver will go higher long term. The fundamentals say yes. The question is whether this was the bottom or just a pause before more volatility. The honest answer is, we don't know yet. Confirmation requires time. Confirmation requires price action. Confirmation requires March delivery results. 21 days until COMEX faces 429 million ounces of demand against 103 million of supply. 11 days until Chinese vaults empty at current drainage rates. The countdown continues. Do your due diligence, understand the risks, make decisions based on analysis, not emotion. Invest with logic, not hype. This is finance currency. Stay informed, stay analytical, and I'll see you in the next one. Finance currency out.